apexinvesting.com. And Nadex and Apex, two complete separate companies. Nadex is the exchange. Apex, we're an online community of traders helping traders. And if you've been with us for a while, as you know, we cycle back through some webinars. We'll sometimes cover, some pretty advanced, strategies and systems of different ways to trade some of the Nadex capped risk products. And then sometimes we cycle back through and we kind of start over with the basics, especially for, since there's always new people coming on. So tonight we're going to be talking about the basics of Nadex spreads. Last week we talked about the basics of binaries. Tonight we're going to cover the basics of spreads. So if you're a veteran trader and you've been trading Nadex for a while and been with us for a while, some of this may be some more elementary type basic stuff for you. But again, you have to remember we were all there at one point and all started brand new. And so tonight we're going to be talking about just the very, very basics of Nadex spreads. A lot of people are familiar with Nadex binaries, but they're not real familiar with those. Hey, what are those spread things? I see those on the platform. I've heard about them. I don't really understand what a spread is or even how they work. And so that's what we're going to cover tonight is Spreads 101. So let's hop right in. Let's get our disclosures knocked out here. Trading futures, options, or any financial instrument involves risk, may not be suitable for every investor. The information presented here in the webinar is for informational and educational purposes only and is not an offer or a solicitation of an offer to buy or sell any particular financial instrument offered by Nadex, and past performance not indicative of future results. So if you are brand new to Nadex, hop on over to nadex.com. You can get some information there about the two products that they offer, binaries and spreads. You can also sign up and get a free $25,000 demo trading account. That way you can get familiar with the Nadex platform, get familiar with the products they offer, entering and exiting orders, and you can use your demo account to practice and master any new strategies or systems that you may be testing out. You always want to use your demo account and demo money for that, not your live money. So take advantage of that. Get a free demo account. Hop on over to our website. You can visit us at apexinvesting.com. That's not real clear there. I need to change that. It's apexinvesting.com, and you can get a free basic membership. Just sign up and select a username and password. You can get access to literally hundreds of hours of free education and webinars. We have step-by-step training courses in there that walk you through. It's not just a webinar on binaries or just a webinar on spreads. It's literally a step-by-step training course, starting off with, the basics of binaries, basics of spreads. What are they? How do they work? Why are there so many different ones? How to enter and exit orders? Everything you would need to know. And again, that's all absolutely free education information you can take advantage of. We have some news calendars. We have some free binary and spread scanners you can use, make it a lot easier to find some the best Nadex, strike on your binary or your, the best spread available for whatever strategy or system that you're checking out. Show you how to get some free charting platform, free futures and Forex data. So check it out. Get a free basic membership there. While you're at it, hit us up at facebook.com/apexinvesting. Like us and follow us on Facebook. It's a great place to stay up to date on any new strategies or systems or upcoming webinars or big news events you need to be aware of. Once you've liked us on Facebook, click the liked button and set it up right here for all posts. That way you get notified of all posts and don't miss out on any big announcements coming out. So tonight we're talking about what is a Nadex spread, why trade Nadex spreads, what's the value of trading them as opposed to trading other instruments, how to trade with reduced risk, and show you that you can use Nadex spreads to trade in any market condition around the clock. So to make money in trading, there's three things you need to really be aware of, all right? For one, how to reduce risk, okay? That can be one of the #1 reasons that traders fail. It can be one of the #1 reasons that traders can blow their account is because they don't have good risk management. But also how to increase your leverage. That way you're not having to put up as much money out of your account, or you're not having to have a huge account to be able to trade. And how to give yourself more time to be right. And I'll show you some examples of what I mean by all these things here. So what are Nadex spreads? Okay, Nadex calls them bull spreads, but if you buy them, you're bullish. If you sell them, you're bearish. We like to call them box spreads because if you draw them out on a chart, they kind of look like a box, and I'll show you that here. So let's talk about leverage. What is leverage? Well, when you use margin on securities, you're borrowing money from the broker. Therefore, you could be paying interest to the broker on those borrowed funds. For example, you may have $10,000 in your trading account, and if you only have to put up $5,000 in margin, what is margin? Margin is the amount of money that is placed on hold from your account in order to enter into a trade. Okay, so if you have 10 grand in your account, for example, you may only have to put up $5,000 in margin to enter a trade. Therefore, you're borrowing the other $5,000. If you're trading with cash, you have no leverage. Your risk is equal to what you're putting up. For example, if it costs $100 to get into a trade, whatever it is you might be trading, you actually put up the $100, and the $100 is your full risk. Okay. Now, with Reg T margin requirements set in place, you normally have 2 times leverage. You have 50% leverage risk, but the risk is equal to the value of the underlying. Most people have this kind of leverage in their accounts, might not even know it, but if something costs $100 to get into, you know, if the value of it's $100, you may only have to put up $50 yourself, but the risk is still $100. Okay. The risk is still equal to the value of the underlying. Let's talk about futures. Let's say that you're trading futures. Okay, you have a futures account, you're actually trading future contracts. There's several different types of margins required there, and different brokers have different margin requirements. You have your initial margin, which is the amount of money you have to enter a trade if you're not using day trading margin. Okay, also this is the amount of money you must have if you want to hold a future contract from the close of one session to another, okay, like overnight. Maintenance, that's the amount of money that's set aside while the trade is open if you're not using a day trading margin. Day trading margin is usually a little bit or quite a bit less. Okay, this one the broker allows a highly reduced amount of capital, usually only 10 to 25% of the initial margin, on trades that are opened after the new session starts and closed before that session ends. Meaning if you're a day trader and you're just trading throughout the day and you're not holding something into the next session, or maybe you're only holding it for a few minutes or a few hours. Okay. You have day trading cash market hours. That's when the broker only allows day trading margins during cash market hours when the stocks trade like 9:30 to 4. Some of you are like, okay, I don't understand all this margin. What is all this about? Well, I'm going to show you some examples here. Okay. Now let's talk about leverage. What is leverage? All right. Well, leverage can vary by the broker or the country that you're in. Okay. Leverage could be 1-to-1 or it could be 400-to-1. But all types are uncapped risk. Okay. In the United States, it's usually 50-to-1. So if you're going to trade Forex, for example, if you're going to trade 10,000 US dollars, it only costs you about $200 in margin. All right, you only have to put up about $200 to be able to enter a trade on 10,000 US dollars in Forex. But you still have the full $10,000 risk, okay, if buying the FX pair, and even more if selling it. All right. Now, granted, it's very unlikely that the market's going to move that far against you, but leverage is being able to only put up a smaller amount but be able to control a larger amount. Okay, and that's how you can utilize a smaller account to trade, you know, larger instruments. But you do still take on a lot of the risk. So margin and leverage vary depending on which one of the dozen strategies you use. The risk can be capped or it can be greater than your investment. The risk can even be larger than the size of your account. Okay, not only could you lose everything in your account, but still be obligated for losses beyond what is in your account. Here's a little bit of a comparison. Okay, let's look at some different products out there. Let's say that you're day trading the euro dollar. Okay, well, let's say that you're trading an ETF. Okay, you've got $125,000 leveraged. You're going to be putting up a day trading margin of $31,000. Your leverage is 4-to-1. Okay, let's say you're trading spot Forex. All right, where you're trading $125,000, you're leveraged $125,000, you're going to have to put up about $3,100 just to enter into that trade. All right, just as margin, just what's going to be set outside, pulled out on hold of your account to enter that trade is going to be about $3,100, giving you, like we mentioned earlier, a 50 to 1 leverage there. Okay, let's say you're trading futures on the euro dollar, like the 60 futures. Okay, again, controlling $125,000, you're only having to put up about $500, okay, for that futures contract. So that's giving you about a 250 to 1 leverage. Some of you are options traders, are familiar with options. Let's say that you were trading euro dollar options. Okay, well, your day trading margin would be about $2,500, giving you a 49 to 1 ratio. Let's say, for example, though, you're trading a Nadex spread. Okay, and you're trading this particular spread right here, the 24.90 to 27.40. Again, still controlling the same amount of money, but only having to put up about $250 in margin. So you can see the difference here, 31,000, 3,100, 500, 2,500, or $250. Okay, giving you a 500 to 1 leverage there. All right, so that is one of the big powerful things about Nadex spreads. All right, is you can get into them with a lot less margin, a much smaller account, and still have great leverage. Okay, so one of the biggest things about the Nadex products, whether it's the Nadex binary or Nadex spread, is that everything on the Nadex exchange is capped risk. Okay, somebody's saying the sound's kind of fading here. Bear with me. Hopefully it comes back. I'm down in Texas here, and as you might be seeing on the news, we've got some crazy weather going on here. We got flooding and storms and wind and rain and hail damage on cars and windows. It's a nightmare down here. So my internet and my power has been a little shaky the last couple of days. So bear with me here. So on the Nadex exchange, all products are capped risk. You can never lose more than you put up in margin. Remember we talked about before, like if you're trading spot Forex or certain other products, you can lose more than what you put up in margin. You could lose even more than what's in your account and still be obligated. But with Nadex, you cannot lose more than you put up in margin. Your risk is your margin. Okay, so that makes it very simple. But you still get great leverage, as we just looked at. You can trade stock indices, you can trade U.S. stock indices, some overseas indices, you can trade future commodities and Forex pairs. And the price is driven by the underlying market. It's not driven by supply and demand of the spread, as the market maker is making the market based on where the underlying is. So Nadex spreads are a great way to emulate the actual move of the actual market. And it moves in pips. Pips is the last digit quoted. Okay, and every digit is worth $1. All right, $1 per tick or $1 per pip. So let's take a look at a spread here. Remember I told you before, we call them box spreads. They kind of look like a box when you put them on a chart. So what is a Nadex spread and how does it work? For those of you that are familiar with Nadex binaries, forget everything you know about binaries. Do not think of spreads the same way you think of binaries. With binaries, you think of a binary as, okay, at expiration, it's either worth 0 or it's worth 100, right? That's it. Like in binaries, we're just looking for the market to be either above or below a particular strike price. We don't really care by how much, whether it's 1 tick or 50 ticks. We just want it to be above, right? If we're buying and it's an all or nothing scenario. That's not how spreads work. All right, spreads again are based on $1 per tick of movement. A spread has a ceiling or a top, and it has a floor or a bottom. So again, there's just a top and bottom, ceiling or floor. So let's just say, for example, this is an example of, say, the euro dollar. Let's say the floor of this spread was 1.2400 and the ceiling of the spread was 1.2500. Okay, so the spread is the difference between the floor and the ceiling. All right, so this is a 100 pip spread. There's 100 pips between the ceiling and the floor. And again, it moves in pips or ticks. Pip is the last digit quoted. Each pip is worth $100. All right, so this spread's value is 100 pips. Each pip is worth $1, therefore the spread is worth $100, but not in the sense that a binary is worth $100. Let me explain here. All right, let's say that we're selling the spread. Let's say that our indicators, our charts, our strategy, or system that we're using is telling us that the market is going down. All right, so if the market's going down, we want to go short, we want to sell. All right, well, I can't lose, so I'm saying the market's going down. What if I'm wrong and the market goes up? I can't lose any additional money above the ceiling, okay? So if I sell, saying the market's going down, but I'm wrong and it shoots up 100 pips against me, I don't lose any more money past the top, past the ceiling, okay? I've capped limited risk. And I know ahead of time before I ever get in exactly what that risk is. And I don't get stopped out, meaning if I think the market's going down, but it actually comes up and it hits this ceiling or goes through this ceiling, it doesn't just close out my trade. My trade is still open, okay? So like here, it came up past the ceiling, went up, but my trade was still open, which gave me more time to be right. Remember we talked about that? Gave me more time to be right, and look what happened. The market did end up coming down. I was right. You ever had a trade like that where you're saying, hey, I think the market's going down, and it eventually does go down. But first of all, it spikes against you the other way, and you think, oh, I'm wrong, and you close it out for a loss. Then it does go your direction. I'm sure we've all had that, right? We ended up being right. We just weren't right then. The market popped against us first, then went in our direction. So we can't lose money above the ceiling, but we don't get stopped out just because it hits the ceiling. Our trade is still open. And if we're right and the market does go down, we don't make additional money below the floor. Okay, that's why it's a box spread, kind of what it's boxed in. So let's look at an example here. Let's say that I am going short. I want to sell the euro dollar, and let's say I sell it at right here at 1.2490. Remember the ceiling's right here at 2,500. I'm selling at 2490. Okay, that's where the market's at when I get in. That's where I can sell the spread of 2490. Well, what's the difference between the ceiling, which is 2500, and where I'm selling at, which is 2490? That's a difference of 10 pips, correct? So what is the most, if I'm selling, saying the market's going to go down, and I'm wrong and the market goes up, what's the most that I can lose? Because if the market goes up against me, 50 ticks against me, do I lose all 50 pips? Or can I only lose money up to the ceiling? Right, exactly, Phyllis. I can only lose money up to the ceiling. So the most that I can lose on this trade is what? Each pip is worth $1. So the most I can lose is 10 bucks. 10 bucks is my maximum risk on this trade. And therefore 10 bucks is all I have to put up in margin for this trade. I only have to put up 10 bucks to get in this trade, and the most I'm risking, the most I could lose is 10 bucks. So each pip is worth $1. There are 10 pips here, so my cost and my max risk is $10. Now, from where I sold right here at 2490, going down to the floor is what? 2400. So from where I sold 2490 down to the floor 2400, so there's 90 pips difference in here from where I sold to the floor. Okay, each pip is worth $1, so I could potentially profit $90. That would be the most that I could make is $90, because again, I only make money to the floor. And once again, if it hits the ceiling or hits the floor, it does not automatically close me out. So let's look at the opposite. What if I was buying the spread? Well, if I'm buying the spread, I'm saying the market's going up. And again, if I'm right and the market goes way up, I can't make additional money above the ceiling. But again, I can't lose additional money below the floor. So if I'm buying and I think the market's going up, but I'm wrong and it goes down, I can only lose money to the floor. I've capped limited risk. So let's just say, for example, that I was buying the spread because I thought the market was going up, and I bought it right here at 2410. Okay? Well, same situation. I'm buying it at 24.10, saying the market's going up. But if it goes against me, goes down, I can only make money to the floor. Or I can only lose money down to the floor. So again, 24.10 where I bought compared to the floor of 2400 is 10 pips. So each pip is worth $1. There are 10 pips of risk here. So my maximum risk, my maximum loss is $10. And therefore $10 is the amount that I have to put up to get in the trade. So as you see here, I don't have to have thousands of dollars, for example, to be able to get into a spread trade. All right, and once again, if I'm buying at 24.10, saying the market's going up, I can make money all the way up to the ceiling. Even if it goes past the ceiling, it doesn't matter. I can only make money to the ceiling. So I've got 90 pips of potential profit there. Okay. Now, spreads, just like binaries, do have expiration times. They open at a certain time and then they expire at a certain time. And you can close the spread at any time before expiration. You can hold it till expiration or you can close out early. Okay, now, so let's just see if the class is awake here and give an example. Let's say that I bought into this spread right here in the middle. Okay, the bottom was 2400, the top was 2500. Let's say I bought at 2450, like right in the middle. Like the examples I gave you earlier were real close to the floor or ceiling. What if I bought right in the middle at 2450? How much do you think I'd have to put up in margin? How much money do you think would come out of my account if I bought right here in the middle at 2450? Exactly, because this is a 100 pip spread. If I buy right here in the middle at 2450, well, the amount I have to put up in margin is my maximum risk. So if I buy at 2450, saying the market's going up, but it goes down, what's the most I could lose? Well, if I bought at 2450, the most I can lose is down to 2400, so 50 bucks. Therefore, that's how much I'm going to have to put up to get in this trade. What if I bought way up here at 2480? What's the most I could lose if I was wrong? Yeah, 80 bucks. And 80 bucks would also be the amount that I have to put up to get in the trade, right? Okay, does that make sense? So with a spread, you can, depending on where the market is and where the spread's priced at, you could get in anywhere, all right? And you can get out at any time. All right, let's say, for example, let's say that I bought the spread right here at 24.10, like we showed before. And the market came down, and then the market started coming up, and it went up here to 24.50. So I bought at 24.10. It went up to 24.50. Granted, it kept going, but let's say at the time that it got to 24.50, I had to run. I couldn't trade anymore for the day. I had to be somewhere, and I just want to close out the trade. Well, how much profit would I make then? So I bought at 24.10. I got out when it was here at 24.50. So that's 40 pips, 40 bucks, right? That makes sense? Granted, had I been able to trade longer, yeah, it went all the way up here to my ceiling, and I could have closed it out and made 90 bucks. Okay? So I can exit, or I can enter or exit any time. I don't have to hold it all the way to expiration. I can get in, let it move a little bit and get out. Or let's say that I had bought it right here at 24.50, thinking it was going up. But instead it went down 20 ticks against me. And I just wanted to close it out. So if I bought it at 24.50 and it went down to 24.30 and I got out, how much would I have lost? 20 bucks, right? Okay, so I can close out early whether I'm profitable or whether it's going against me. Just because I had to put up 50 bucks to get in, and 50 bucks is the most I can lose, do I have to let it go a full $50 against me? No, I might say, hey, I was wrong. Market's not going up, it's going down. Let me just close out now. Now, if I do hold it all the way to expiration, okay, the spread, if the spread expires, it will close at the settlement price at the time of expiration. The settlement price is based on the underlying market. So what do I mean by that? Let's say that I bought it down here at 24.10. The market came all the way up and it hit the ceiling. Remember what I said, when it hits the ceiling, that's the most I can make. But does it automatically close out my trade, or is the trade still open? Trade's still open, right? The trade will stay open until expiration or until I close it. So if I bought it at 24.10 and it came all the way up here to 2,500, is it a good idea to maybe close the trade right there after I've made the most that I can make on that? Yeah, because why? What happens? It gets up here and then comes down and gets up and comes down, right? Okay, and what happens? It comes all the way back down. And granted, it did come back up again, but then I left it till expiration, so it expired down here about 24.80, say. So I bought at 24.10, it expired at 24.80. I still made 70 bucks, so I'm happy. But I would have made more by closing it out at the top. Take my profit and run. Exactly, Sam. Okay? There's no reason once I've hit my max profit to leave this open, because I can't make any more. I should close that trade and look for another trade, right? Make sense? Okay. So somebody's asking, can pips ever be worth more than $1? No, with a Nadex spread, it's always $1 per pip. Now, you can do 10 spreads though and have $1 a pip, just like you would on, you know, a Forex lot, for example. Okay? So it's $1 per pip. They're never worth more than $1. Okay? Tammy says, when you say close it out, is that the same as selling back your buy? Exactly. Exactly, Tammy. So if I bought in right here at 24.10 and it got up, you know, to 24.50, and I wanted to get out, I would just sell it. So I bought it at 24.10, sold it here. What's the basics of business? Buy low, sell high, right? Or if I sold up here at 24.90, I'm selling high, it comes down, I want to buy it back, I buy low. So yes, exactly. Okay. Let's see here. So you've got a combination of different markets, time frames, and spreads. It's possible to find a variety of choices to help you and find one in the time frame with the risk and reward parameters that fits your trading strategy. What do I mean by that? Well, there's all kind of different expirations. Okay, you've got intraday spreads that are as little as 2 hours. You've got daily spreads that go up to 22 hours and 15 minutes. Now, some of these larger time frames will be wider between the floor and ceiling. What do I mean by that? Let me just pull over. Let's take a break from looking at these boring PowerPoints for a minute, right? All right, here's the Nadex. Here's a Nadex demo platform. Okay, let's see here. Give me just a second. Let me check out a couple questions here. Make sure. Are there any questions at all on the basics of what we just covered? Okay, I'll show you where you can get some more kind of in-depth info, but on the basics we just covered of spreads. Spreads have floors and ceilings. You can't lose or make more beyond the ceiling or floor, and you can hold it to expiration, or you can get out early, and everything is $1 per tick. Okay, let's see here. George, if you go to the apexinvesting.com website that I told you about over at our website there, go to apexinvesting.com and sign up, get a free username and password there, and you can go on to into our forum and do a search for that, or you can submit a help desk ticket and I can get you a list. We actually have a list of options there for that. Okay. All right, for Canadians to help you out there. What's the expiration times for spreads can we choose? Yep, Sam, I'm about to show expiration times right now here in just a second. Mike, yes. FIFO, I got out of the trade at, okay, Fortune says if I got out of the trade at 2,500, could I still sell it since that seems to have gone, since it seems to have gone down after? Yes, absolutely. Yep. what you could have done, I think what you're asking here, Fortune, is let's say you bought it at 24.10, thinking the market was going up, and it did. The market went up, boom. Got up here to 2,500, you made the most you could make, so you close it out for profit, right? Market's kind of teetering around there, starts to come down, and your charts, your indicators, your strategies and systems saying, oh, market's going short now. Yeah, you can get right back into the same exact spread and sell it and take it down short and take your profit down here and get out. And your charts tell you market's coming back up, oh, going long, get right back into the same spread and buy it here. And absolutely, that's the great thing about spreads, is it's just like trading the market itself when it's going up and down. You can buy it, you can sell it, you can buy and sell the same one multiple times throughout the hour or the day, okay? Or you can use different ones, okay? Let's see here. Enrico, can I buy a spread at the floor, or is there a minimum price to get in? Normally what you'll have there, Enrico, is you'll have a little bit of premium you'll pay in there. Like in this example, 2,400 to 2,500. Let's say the market was literally at 2,400, okay? Normally it's not going to let you buy it exactly at 2,400 and have absolutely zero risk. You might have to buy it at like 2,405 or something, okay? So that there's like, you know, a $5 margin or risk in there. And so, you know, the market might have to move 5 pips before it actually catches up with exactly where you bought it or something like that. Does that make sense? Chris says, can we buy below 2,400? Nadex spreads have different pricing on them. You'll sometimes find them priced a little outside of the floor, but it's not going to really do you any good, or you're not going to start, even if you buy it, even if it's priced below the floor because there's a little bit of premium there, you're still not going to make any money until the market reaches that floor and then starts ticking. You can only make money between those lines. No matter where you sell or where you buy, you only start movement inside those lines, if that makes sense. Okay. George says, is there a minimum account balance to day trade Nadex? Yes, George, it's a minimum of $100 to open an account with Nadex. Okay. So all it takes is $100 to open an account with Nadex. After you have an account open, your balance might go down to, you know, $20. Let's say that you lost a few trades and your balance is down to $20. Well, as long as there's a spread available out there with less than $20 risk, you can trade it. So it's $100 to open an account, but as far as to be able to trade, I mean, for example, here, let's just go to Forex spreads right now. Let's look at the euro dollar. There were some spreads that are from, we'll take a look here on the euro dollar, okay? Oliver says, at expiration, does the settlement price affect you outside the spread? No. I think what you're asking there, Oliver, is, let's say I bought it for 24.10, the market went up to 25.10 and expired there, and it just closes out the trade. I still make the 24.10 to 2,500. The market can keep going hundreds of pips, okay? But all I'm going to make is from where I bought to the ceiling if it keeps going up, okay? So it wouldn't affect you negatively if it expired outside of the spread. It's not like a binary, or it's not like a limit, meaning, okay, you have, that's actually a really good question, Oliver, because if you're asking that question, that means probably 10 other people are thinking it. Okay, Oliver brings up a good point. The ceiling and the floor protect you and cap you, meaning if I'm buying at 24.10 and I'm wrong and it goes way down, I'm not losing hundreds of dollars. I'm not losing thousands of dollars. I can only lose to the floor. If I'm wrong and the market goes way up, I only make money to the ceiling. But I think where Oliver's getting at is, hey, does the market have to stay between these lines? Like, hey, I'm right that the market went up, but it can't go up more than this. No, it can go as far as it wants. Okay, you're not limited to, you know, it has to be between these two. okay, meaning, oh, the market can't go outside of it or I lose the whole thing or I don't get my payout. Nope, it's not like that at all. The ceiling and floor are there to protect you and cap you, but it doesn't cap you. Again, if I bought at 24.10 and the market went up to 26.10, hey, I was right. The market went up and I make from here to here. Now, but what do you think I might want to do if I bought at 24.10, the market gets up to 2,500, so I close it out and I take my 90 bucks, but everything on my chart, strategy, system, indicators tell me the market's still going. Well, what if I can find another spread that goes from 2,500 up to 2,600? I could get right into another spread and keep riding the market up, can't I? Let's take a look at that. Let's take a look here on the Nadex platform. So as you notice, euro dollar here, for example, we've got some spreads that open at 6 p.m. and they go until 11 p.m. You've got some spreads, those are 4-hour spread or 5-hour spreads, and notice those are 250 pips wide. All right, the ones that we just looked at as an example are 100 pips wide, just like these. Opened at 6 p.m., they'll expire at 8 p.m. These opened at 7 p.m., they'll expire at 9 p.m. What do you think is going to happen at 8 p.m.? There's going to be some 8 to 10s. Okay, now let's take a look here. Let's take a look at these 7 to 9. All right, notice there's 3 different spreads. See that? Okay, and I've asked this question before. Some of you probably know the answer to it, but as far as how do these spreads work? Without looking at a chart, and I don't have a chart in front of me, these euro-dollar spreads opened up at 7 p.m. They opened about 40 minutes ago. Who can tell me, just by looking at this page, where approximately was the euro-dollar at 7 p.m. Eastern time? Don't look online, don't look at a chart. Who can tell me? Yep, Phyllis got it. 1.1310. How do I know that? How do these spreads work? Who determines this floor and ceiling, top and bottom? That's confusing to me. Well, don't let it be confusing to you because it's really, really simple. All right, and what I'm going to do, give me a second here, I'm going to open up a chart just to make it even more simple for you. Notice that there's 3 different spreads available. Okay. Let's see here. Let me just get this chart going. Give me just a second here. And this is going to make a lot of sense here for you. Okay. This is really going to, one of the other big confusing things to new people about spreads is, okay, I get that floor and ceiling, but how do I know? Like, what is that floor and ceiling going to be? How do I know that I can find something that's close to a floor or ceiling or right in the middle? Or I don't get it really. I'm going to show it to you here, and it's going to make a lot of sense. Okay, and let's see here. Why would somebody trade binaries with more risk when spread is less risky? Well, Sam, that's a good question. Spreads are a lot less riskier than binaries overall, okay? Because it's not all or nothing with a spread, right, Sam? That's the thing. What happens if I buy this binary, if I buy a spread in the middle at 24.50, and or let's use a different example. Right here when it expired, this thing expired about what? 24.80, say. All right? Let's say that I bought this spread at 24.85, thinking the market was going up. But the market went down 5 pips and it expired at 24.80. So I bought it at 24.85. It expired at 24.80. How much money did I lose? With the market going against me by 5 pips and expiring, how much did I lose? Bought it for 24.85. It went down to 24.80 and expired. $5. Actually, Robert, okay? $5. I lost $5. $1 a pip. What happens if I bought a binary for $85 right here? But the market expired 5 pips below the binary strike price. How much did I lose on that $85 binary? Yeah, I lose it all. Right, I lost $85. Okay, so you see the difference there? What if I bought a binary? Okay, let's look at something here. We're not really necessarily doing a comparison tonight, but I just want to put this into perspective. Euro dollar. 8 o'clock expiration. Okay. Let me open a euro dollar chart. Just put this into, and this is why I really think, I know some of you guys are like, you know, I've heard about these spread things, but they seem, I don't know. I want to show you why you really need to pay attention to spreads and really need to take a look at them. Okay. I want to show you why here. So let me get a chart open, and I'm going to show you several things here to kind of piece all this together, and then we're going to wrap up. I just really want to have tonight just kind of open your eyes to the world of spreads. Is it the opening price that controls the next spread? John, yep, it kind of is, and that's what I'm going to show you right here. Okay. Oh, I did that wrong. I want to do 6, not 16. All right, let me just put on a couple things here so that I can show you what we're looking at and have this make sense to you. And this will really kind of make spreads click and go, ah, now I get it. All right, we want current price, and we want toolbar shortcut. There we go. Okay, so let's take a peek at something here. Nope, I don't need that right now. Let's do a minute, let's do 5 minutes. Okay, so remember when I told you a minute ago when I asked this question right here, and Phyllis answered it right. She gets the gold star. Forex spreads, euro dollar. Okay, remember when I said, hey, it's 7 o'clock? What was the euro dollar at? Without looking at a chart, who can tell me? Phyllis said it, 13.10. How did Phyllis know that? Because look at these 3 spreads, okay? Each hour when these new ones open up on the Forex market, there's 3 spreads. And what does it say right here? They're 100 pips wide, right? How are these spreads determined? How are the floor and ceiling determined? John asked that. Look at this number right here, 13.10. Notice that number is also right here, 13.10. Okay? So you see on that spread, 13.10 is the floor of the spread, and on the top, 13.10 is the what? Ceiling of a spread. So that means that these spreads opened up at 7 p.m. So basically at like 6:58, all right, when it's calculated of where is the market at, that's how the floors and ceilings of the next spreads are determined. Does that make sense? And take a look here at the chart. Right about 7 o'clock, where was the euro dollar? 13.10. Everybody see it over here? 13.10. Right? So how does that work? How do they do that? Well, ding. Does that make sense, John? You see it? Now let me put it into a little better perspective. I'm going to go back to a different type of chart here, just because I think it's easier to see. John, another way to see it right here. See these ones that open up at 6 p.m. to 8 p.m.? Well, the market was about the same price then. It didn't really move, so that's not a good example. But okay, so let's take a look here. Here's the euro dollar, right? So let's bring this chart way in here. And I'm going to squeeze it. Okay. So at basically 7 o'clock, the market was at 13.10, correct? And notice these new spreads that come out on the hour, 6 to 8, 7 to 9, 8 to 10, what are they? They're 100 pips wide. And there's 3 of them. So how do you think they do that? Well, right when these open up, the market's at what? 13.10. So here's what happens. You take 13.10, okay, and they make a spread. And 13.10 is the bottom of this spread, which means what? Also, the bottom are also known as what? The floor, right? And they make 100 pip spread out of it. So there's a spread that has 13.10 as the floor, the bottom, and it goes up 100 pips, right? Notice it. 13.10 is what? The bottom, the floor, and it goes up to 14.10. Goes up 100 pips, right? Look at the spread up top. There's another spread that has 13.10 as the what? The top, the ceiling. And where does it go? Down 100 pips, right? So there's another spread right here. 13.10 is the top going down 100 pips. Obviously that's not 100 pips, but you see what I mean, right? Does that make sense? So if at 7 o'clock, I think the market's going to go up, am I wanting to buy this spread on the bottom? Or do I want to buy the spread on the top? The top, right? But if I think the market's going to go down, I'd want to sell this one here that goes down. All right, does that make sense? Now, there's a third spread that's also 100 points. How do you think it works? Well, this is also a 100 pip wide spread. So where do you think right here in the middle will be priced at approximately? 50 bucks. So 13.10 would have 50 going up and 50 going down. Let's look at it. So we have one where 13.10 going down 100, 13.10 going up 100. Then we have this 12.60 to 13.60, so what's right in the middle? 13.10. All right, does that make sense? Does that help make spreads a little simpler? Because a lot of people are like, okay, I get this whole dollar a tick thing, but okay, I click here on 6 to 8 and there's these spreads, and then I click 6 to 9 and then there's 3 different spreads. Then I've got these 6 to 11s and there's 3 different spreads. What's the difference? Okay, that at the top of the hours when new spreads are released, Robert, yep, that's how they're always released. Like 2 minutes before, like when new spreads are going to come out here in 9 minutes at 8 o'clock. Okay, so at 7:58, wherever the market's at right then, that automatically in the background determines what the floor and ceilings of the new spreads are going to be. Okay, And so you can kind of know coming up to it, all right, there's going to be some new spreads released here. So I can get in some brand new ones if I want. Or, yeah, exactly. It's Nadex. That's how Nadex determines what the spreads are going to be, because it's whatever the market is at just a minute or two before the new release. Okay, but yeah. Robert, is there always a middle? Yep, there's always the middle. There's a top, a bottom, and a middle. It's always released. Even on these right here that go from 6 p.m. to 11 p.m., even these 5-hour spreads, at 5:58 p.m. tonight, whatever the market was at, about 1310 even then, because it hadn't moved, that's what determined these spreads that are 250 pips wide. See, 1310 is the ceiling of this one, the floor of this one, and this right in the middle. Okay, so you've got spreads that go from 6 p.m. to 11 p.m. Like right now, what do we have? We have 6 p.m. to 11s, we've got 6 to 8s, we've got 7 to 9s, and look, we even have dailies for tomorrow at 3 p.m. that we can get into right now with 19 hours to go. There's always spreads to get into. Okay, does that make sense? So yeah, I mean, absolutely. And you don't want to just randomly get into a spread. You don't want to randomly just get into all the spreads. You want to have a direction you're going, either buying or selling. You don't want to just randomly go in and say, okay, well, I can go in and if I want to buy this spread, okay, what about, so I got to put up $96 on that one. I got to put up 50 for that one, and I got to put up, I only got to put up $5 for that one. I want to just take that. I'll risk $5. Well, you don't want to do that, because you don't want to just randomly look for something that's cheap and low risk, because you don't even know if the market's going that direction. You're just going to be blowing $5 and $10 all over the place. Okay, you want to, yes, use your strategy or system to determine what direction the market is going. Okay, and yes, on the spreads right here, you've got the offer side and the bid side. The offer side is the price you can buy it for. The bid side is the price you can sell it for. Okay, so Brett, that's the difference of bid and offer. Like for example, on the buy side, there's 50 contracts available right now. You can do one spread or do 50. On the sell side, there's 50 available. Okay, the difference between this bid price and offer price, that's what's called the bid-ask spread. All right, that's how the market makers make their money. All right, market makers are not trading against you. All right, no one's trading against you here. The market makers make their money of, hey, I'll sell it to you for this or buy it from you for this. They're just making that difference. Okay, so let's see here. Just going through a couple questions here, trying to make sure I'm up. Are these the same as butterflies, condors, fence spreads? No, these are directional. A spread by itself, Shavar, is a directional trade. Now you can, do a couple of combinations. You can do some combinations of spreads and get into iron condors and premium collection. There's, it's kind of some advanced techniques. I can show you where you can get some info on that. But a spread in and of itself is more of a directional type trading. So yeah, you can go over to the Apex Investing website and go to the Elite Education section on spreads, and it will go through and teach you all about how to trade spreads, show you some different trading systems we use for spreads, show you how to use them for some news trades, iron condors, premium collection, and that's all free, to get all that education. Okay, so does that make sense how spreads work? And does everybody now understand how spreads are determined? Okay, how they're determined and how the new floors and ceilings are set up. So it kind of makes it a lot simpler now, doesn't it? When you're looking through here at these different options, you're like, wait, what is this? And these, what? Now it's kind of laid out for you, and you understand a little more what spreads are all about and how spreads work. Okay, so now I want to show you one other quick thing, and then we're going to have to get rolling here. Let's say that I wanted to trade the euro dollar. Okay. Let's say I want to trade the euro dollar, and I don't have all of my charting stuff on here, but let's just say, for example, I thought the euro dollar was going up. Okay. So let's say that I enter a spread trade. Let me just get rid of all this. So let's say I thought the euro dollar was going up. So I enter a spread trade right here. Okay. I get into a spread. Okay. And let's just say, for example, that I want, all right, euro dollar, 9 o'clock, and I want to buy this 13, let's even say this middle one. Okay. So I had to put up 50 bucks, right? Everybody see that? If I took that middle spread, I'd have to put up 50 bucks. Okay? I have to put up a lot less to go with this spread, right? I only got to put up like 5 bucks. Well, let's say I went with, let's just say, because I want to keep this fair, I went with this middle spread. I had to put up 50 bucks to get in this spread. Everybody follow me? Okay? Now, let's look at binaries for 9 o'clock. I would think the market's going up, right? So let's say I want to, let me refresh this. I want to buy a binary. And let's see here, binaries, euro dollar, 9 p.m. 1306. I can buy this binary for 63 bucks at 1306. All right. So right here is 1306. Everybody see that? If I bought that binary, that's where I'd be buying it. Is the strike price of 1306. You see it? 1306, I can buy it for what? $66 right now. So I've got to put up 50 bucks to get in my spread trade. I have to put up $63 to get in the binary trade. Right? So I am wrong. At 9 o'clock, I'm wrong. The market didn't go up. The market went down to 1304, and it expired at 1304. Did my binary win or lose? The binary I bought for $63 at a strike price of 1306. Did my binary win or lose? My binary lost. And how much did I pay for that binary? $63. So the market went down to 1304 and I lost how much? $63 on the binary. The spread I got into at 1308 went down to 1304, went down 4 pips. How much did I lose on my spread? $4. Some light bulbs going off there. If you're a newer trader and you have a smaller account, should you be trading binaries or should you be trading spreads while you're learning the system and learning to read the market? Yeah, because if you've got, let's say, just a few $100s in your account, and right now it's 8 o'clock, and we're looking at 9 o'clock expiration. Well, if you got in a trade and in the next hour, 1 hour from now, you were wrong, and on your spread you lost $4, you're like, oh man, that's not what I wanted to happen. All right, Well, let's keep trying. Let's try another one. $4. If you right now knew an hour from now that you've got $300 in your account, but you were going to lose $63 of it possibly in an hour, and your account just went from $300 to $230, that messes with your head a little bit more, doesn't it? Doesn't make you feel like you've got a whole lot of more times to be wrong, does it? But when you're lost 5, 10, even $20 on a spread, it's like, okay. Everybody get what I'm saying here? So some people are like, well, wait a minute. Well, what's the point of binary? Well, let's look at it the opposite way. Here's the upside to it. What if the market, what if you're right and the market did go up, and the market went up and it closed at 1310? Well, you bought this binary for how much? You bought the strike price of 1306. You bought the binary for $63 on the binary, right? Okay, the binary right here, you bought it for $63. The market expires at 1310. Did you win on that binary? Yeah, you won on the binary. And how much did you win? Well, you bought it for 63. It expired being worth 100. So you made like $37. Pretty cool. How much did you make on your spread? You got into the spread at 1308. The market expired at 1310. You only made $2 on your spread. So that is the flip side, is with a binary, binaries are volatility products, meaning one tick, even 1/10 of a pip, can mean the difference of a binary winning or losing all or nothing. So yes, in an example where the market only went up a couple pips, you're like, oh, I like that binary because I made $30, $37. And I only made a couple bucks on my spread. All right, but when the market goes against you a couple of pips and you lose the whole $67 on a binary compared to only losing a couple dollars on the spread, you see the difference there? So, I mean, that binaries can be valuable, you know, with smaller moves. Let me ask you another question. What happens if you're right and the market went up and the market went up 50 pips by 9 p.m.? 50 pips. Okay. Your binary you bought for at 1306, you bought it for $67. Did it win or lose? It won. It won big time, right? Like, you bought it for 67, the market went up 50 ticks, 50 pips, you made $37. Market goes up 50 pips, what'd you make on your spread? $50. You made more on the spread than you did the binary. So on larger moves, you could potentially profit more on spreads because you're always capped at $100 on that binary. So there's pros and cons to both, okay? I do recommend for new traders and for traders with smaller accounts that they do spreads, and I think you can see, you know, why I would do that, okay? So you definitely, you know, have a potential for higher profits when the markets really move, okay? And you've got much lower manageable risk that doesn't boil down to all or nothing, okay? Can I buy at any price a spread, or it must be the price that's on the chart? It must be the price that's listed available, okay? Olympio, like when you go in here to, you know, say Forex spreads, euro dollar spreads. You've got these that are 6 to 11, 7 to 9, 8 to 10. If you click the 8 to 10s, it lets you know right there what you can buy them. And you can see like each spread is priced a little differently. You can get in at 13.13, 13.06, 13.01. You just have to look at the different spreads available and see which one is priced just right, okay, and matches up to the strategy or system that you're looking for there. Okay, but that's the price you can buy or sell them for is what's listed as available right there to buy or sell them for. Okay, so yep, John says the more I learn about spreads, the more I like them. Okay, Chris says why not just trade futures? Well, you can trade futures. Okay, somebody can trade futures, but again, what is the big benefit of Nadex having floors and ceiling is capped risk. All right, you got capped risk. The market goes against you, or if it flash crashes, we've all seen that happen, especially with Forex, where news comes out or whatever comes out and the market just shoots like crazy. Okay, and it can shoot through your stop even depending on where you have your stops there or how you have your ATM strategies. You've got capped risk. Okay, you can also you can't get into a futures trade on the euro dollar for $7 margin or for even $50 margin. You can't do a Forex futures contract, and you can't even do spot Forex here in the US for $50 to get $1 a pip. You'd only be getting about like 10 cents, 20 cents. Okay, so again, for capped risk products and for people with smaller accounts, we talked about that in the beginning, you know, as far as margin and leverage. You know, some people may not have the account size to do spot Forex or futures contracts or to be able to take on $10 a tick, $10 a pip type of risk. Okay. All right, guys. We are over we have ran over here. So I hope that made sense. I hope that kind of helped piece all this together for you and help you understand and see, open your eyes a little bit to some of the possibilities with Nadex spreads. So again, hop on over to nadex.com, get yourself a free $25,000 demo account. You can start playing with some spreads, start throwing some orders on, start whatever strategy or system you currently using. Try them out with spreads and see how this works for you. Okay. Again, also hop on over to apexinvesting.com. Let me scroll through a couple things here for you. Again, hop on over to apexinvesting.com. Take advantage of getting a free username and password. You can go through a bunch of free education on binaries and on spreads. You can go through you know, how to get some free charting platforms like the one I was showing you there. You know, you can go through and watch absolutely free. You can watch some step-by-step videos of different strategies and systems and indicators that we use. Show you live trades of how we trade, you know, spreads and binaries and what our systems are, where we get in, where we get out. You know, really help you out, give you some ideas. We also have what we call a binary scanner and a spread scanner. Let's say that you are trading spreads real quick. Let's say you are trading spreads and that you're like, okay, hey, I think the market's going up on the euro dollar. Okay, I've got these spreads from 6 to 11 and we just got these different floors and ceilings and I can buy them for these different prices. Okay, what about the 7 to 9s? We got these floor and ceilings and these different prices. And then I've got the 8 to 10s, you know, and they've got different prices. And I've got the 3. Okay, now these 8 to 10s, if I were to buy this one, I have to click it, say I want to buy one for it to tell me, okay, max loss 52, max profit 48. All right. Well, what about this one? How much money do I have to put up on this one? Okay, 7. Now, what about the 6 o'clock? You forgot. You've already forgotten by now what's what, how much was which one, right? You're all over the place going back and forth. By the time you finally figure out which one you want to go with, the market's already moved. Well, we have, and this is absolutely free for you to use, we have a binary and spread scanner where it will show you everything on one page. For example, here's the spread scanner. Let's just say I was trying to trade the Nasdaq. Boom, I can pull it up and it'll show me all the spreads in one place. The spreads that close at 4 p.m., close the ones at 4:15 p.m. or whatever I'm looking at. And it shows me ceiling and floor, ceiling and floor. Can buy for this, can sell for this. And right over here, see green and red? What do you think that is? Red is risk, green is potential reward. So I don't have to go click a ticket and enter it and act like I'm going to enter an order to be able to see my risk and reward, how much I got to put up. I can see everything on one page. I'm not having to flip back and forth. So it's really, really simplifies trading spreads, shows you everything on one page, okay? And that's something you can take advantage of for free as well there on the Apex Investing website, okay? All right, guys, if you have any other questions, we're over here, so I've got to cut us off for tonight. If you have any other questions, feel free to hit us up over on the Apex Investing website. You can submit a question or a help desk ticket, and we'll be glad to answer that for you. Yes, this webinar is being recorded. We'll have it on our site, and it'll be on the nadex.com archives webinar site as well here in a couple days if you want to check it out. So, and you can hop on to the Apex site there and get a calendar of any other upcoming webinars. But we do these webinars for Nadex, these educational webinars for Nadex every Monday night at 7 p.m. Eastern. Okay, so Robert, every Monday night we do these, okay, for Nadex, but you can also hop on the Apex site and there's some other webinars we do throughout the week and literally hundreds of hours of recorded webinars to catch up on and check out. So, all right, guys, thank you very much. I sure appreciate it. I appreciate your time. Hit us up over there if there's anything else we can do for you, and we will see you next Monday night. All right, guys, thank you so much. Have a great one.